sometimes what folks really focus on is they'll look at the stock market and they'll say, well, the stock market's up or the stock market's down. And what does my performance look like relative to the stock market? But the problem with the stock market is the volatility in the stock market is usually way higher than what you want to have necessarily in your 401k, let's say. Mm-hmm. And the reason why that is stocks can go, they can go up a lot, but they also can go down by as much as 2/3 in a typical economic cycle. And 2/3 is an extraordinary loss that most people are not going to accept in their 401ks or their portfolios. That's not an acceptable loss for them to experience. And so I think part of the question should be asked, look at the assets that are in there. Are they meaningfully overweight stocks? And remember, stocks are a lot more volatile than bonds. So even a 60-40 portfolio, 98% of the risk of that portfolio is driven by stocks. Mm-hmm. So the question is, are you seeing a portfolio that is diversified, number one? And number two, what I'd emphasize is, are you seeing elevated fees? Now, for a 401k, most of the fees are pretty low, but as you get to advisor managed accounts, fees are a good sign that you're not getting a good deal. So if you run down that list and you start to see fees in the 150 basis point, 200 basis point, 300 basis point, or God forbid, investing in LP structures that are charging 800 basis points of fees, sure. Like the world of fees is just a loss for the investor. And so instead, if you see a portfolio that's oriented around very low cost index funds charging, say, 0.1% of fees, right? That's a good sign. That's a sign that your advisor is operating in your best interest. If you see very high fee products, that's the sort of thing that you should really start to ask real questions about. Why are you getting charged 250 basis points of fees on an asset that you're seeing?